Hey you, and yes, you read that correctly. Today I'm going to share with you how you can get properties for $500, sometimes even for zero. This way you get started in real estate investing with a little bit of money and really start building out that portfolio of yours without owning a bunch of potential liabilities. Now I like to use this strategy because of the fast growth, the lower risk factor, and honestly, I don't have to put out a bunch of cash. Now my name is Kai and I am just a regular dude who was able to leave the day job at 27. I bought some land, hand built my own home, and now I live mortgage free and basically spend my days doing whatever it is I want to do, including making videos for beautiful people just like yourself. And if videos on generating income and learning things about money that schools just don't teach us interest you, then get started, subscribe right here, and hit me up just down below and say hello. Now let's get into this. Slap hands, bump fists, let's go. All right, so here's one of the latest additions to the rental portfolio, and it cost me exactly $0. However, it did cost me a little bit of sweat equity to get it up to code and meet permit requirements. It's in one of the most popular neighborhoods of the city, and it's valued right around $650,000 to maybe $700,000. It's a bit rough around the edges on the inside, but as you can see, it was recently remodeled, and with a little bit of interior design work and some cleaning, it'll be able to rent out for a few $100s a night. So a common problem that I hear a lot is, how do you keep acquiring properties? Because even if you do everything correctly, you have a good credit score, you have a good paying job, you have cash, you cash flow your properties, is that you undoubtedly will hit the glass ceiling of not being able to get more properties. And it's really tough to overcome because it boils down to two main problems. One is you just simply run out of cash. Whenever you get new investment properties, it requires a substantial down payment, usually around 20%. And then the remodel work, which usually costs several tens of thousands of dollars. And then if you're doing what I'm doing, where I do furnished rentals, as now you have the furnishings and the decorations and the artwork, which then usually cost me between $10,000 to $15,000 per property. So cash is the first thing. The second one is the debt to income ratio. We have two ways of really purchasing properties. One is with cash, two is from traditional banks, and they look at debt to income ratio. This causes more problems because if you're an entrepreneur, you're any type of investor, you know the one thing that we try to do is we try to find legal ways of not paying our taxes. Remind you, I'm saying legal. And when you do that, what ends up happening is that your income goes down because you're writing everything off. Now what happens is when they go to the banks asks for your taxes. And what ends up happening is that your income looks pretty darn low because you have a good CPA and you're a smart individual. You understand what I'm trying to get at here? Now there's other options out there where we pull out HELOCs and then we work with hard money and we go private money, and there's all these other options. But right now let's stick to the more the traditional way. So how exactly do I get a place like this without using up a lot of my cash, or actually any at all in this case, and without increasing my debt to income ratio? In business, we call it outsourcing. And in other words, in this case, it's basically paying someone else to use their asset. Now I basically lease the property myself or under my LLC's name, or better yet, I leverage what I'm really good at and just run the business side without any of the risk, also known traditionally as property management. So there's two key things why people really love real estate. Me being one of the most biased characters out there about it, it's one, it's the appreciation, and two, it's the monthly cash flows. Think about this, the cash flow is where the real money is because it's the equivalent of dividends in the stock market. Now, if you have the bankroll, you can get both of these, the appreciation and the monthly cash flows. But for most of us, we usually hit that ceiling, or if we're starting off, we don't usually have the cash to get into it. Now, even if we do have the cash, the pitfall of that, of acquiring a bunch of properties, especially when we're still young and we're still learning, is that you speculate. You're hoping that you're buying a piece of property in an area that will go up over time. If you're newer to the city or you're newer to the market, this can be very troublesome because you could hit it big and at the same time you could lose your shirt on some investments. Number two is that you tie up your cash. And in business investments, you want to stay liquid as much as possible. So here you're basically trading your liquidity for equity in your home, which right now I'm very equity rich, but I do have liquidity through HELOCs, but that's for another time in another video. So let's say for the most of us out there that we don't have a ton of cash or the ability to go out and just plop down a bunch of 20% down payments to acquire a bunch of properties. That's assuming that your debt to income ratio will even allow it. So how does this work? Well, We can't have both. We can't both have appreciation and we can't have monthly cash flows. We're gonna have to pick one. So let's take the best of the two, cash flow. The reason why cash flow is the best is one, it's cash in the bank every single month and it's recognized as income so you can go out and buy new properties. Appreciation is recognized too, but it's harder to get loans against. You want cash flow, liquidity. Now, when I look at properties, of course, I primarily look at cash flow, but that's not the only thing. It's not just long-term appreciation. My value exchange or my value add is when I go into properties and I can buy it and I can fix it up and I can remodel. I'm not talking about flipping. I fix, remodel, and hold and rent. And that's where I can really increase the value or the equity by quite a bit, sometimes hundreds of thousands of dollars. But that's my own personal strategy and that's where I make a bulk of my equity. But in terms of this, cash flow, monthly cash flows, has a very close second. All right, so let's take a second and let's compare the two different models. The first one is the traditional purchase and rent, and the second one and third one is going to be the strategies that I'm trying to pitch to you where we use somebody else's asset to generate our income streams. All right, but first, just like anything else, when we look at problems or we start creating a strategy, we want to make assumptions. Okay, so when we take a look at it, we're going to assume that's a $300,000 valued piece of property that's going to generate us revenue of $4,000 a month, which could be a little bit high, but it really depends on the area. But to keep it simple, let's say $4,000. With utilities and maintenance for around $300 a month, okay? So that's our baseline of what we're gonna build these scenarios around. That stands for management, not the band. Although it's a really good band. So the first line that we're gonna look at is what's our initial cash outlay to secure the property? When we look at purchasing, it's gonna look at 20%, $60,000. To lease, for me, I usually put a $500 deposit until the property starts cash flowing. Sometimes it's $1,000, and then some other times if you're brand new at this and you don't have an LLC and a portfolio and background and all that good stuff, you might have to put first and last month's rent plus a security deposit. When it comes to management, it's a big fat zero because you are managing the property, you don't own it, you don't lease it, you are managing the business. The next one that we're gonna look at is what other cash outlays do we have to do once we've secured the piece of property. Over here at purchasing, whenever I buy property, this is my strategy, I like to increase the value of the property through sweat equity, which I could say is gonna cost me about $40,000 all said and done. Over here at leasing, this can be kind of flexible because when homeowners are really motivated to get it leased out, they will do upgrades for you or they will do basic fixes. So I don't ever actually have to pay for those. I do sometimes have to pay for the furniture to get it to a point where I can rent it out. In that case, it costs me about $12,000 for a home about this value and size. Over here at management, most of the time, if not all of the time, is that they provide the furniture or they will actually pay me, my LLC, do the design work and the furnishing of the entire property. I actually can make money over here, but to keep things simple, I'm just gonna put $0. So now we wanna take a look at the monthly cash outlay. We're gonna make a couple of assumptions here. On a $300,000 loan, well actually it's gonna be closer to $240,000 loan. I'm gonna assume a $2,000 monthly mortgage, taxes, and insurance bill for when I purchase the home. I can easily rent a home valued at $300,000 for right around $2,000 a month as well. Over here at management, guess what? Nothing. The reason is when we do management, we're actually doing a variable fee-based structure of the total revenue, meaning that we have no responsibilities when it comes to monthly payments, upgrades, furniture, or even the down payment. So as you can see so far, it's looking very one-sided. Let's take a look at the cash flows for these different scenarios. $1,700 in cash flow each month. Not too bad. So the same thing applies here. We're making $4,000 a month. We've got $300 in utilities. Our rent is $2,000. So that means that we get. One thing that I didn't share with you before is what I charge for management fees. And these can range, and it really depends on how big the property is, what I think the income could be, but a typical range is 25%. So for this, we're gonna keep it simple. We're gonna say 25% is my management fee. $1,000. Now, right off the bat, you're like, dude, that's a big difference between 1,000, 1,700, 1,700. But let's take a look at something else real quick. What's my total cash outlay and responsibility and liabilities here? 0. $12,500 cash outlay plus a negative $2,000 every single month. We've got a negative $100,000 in cash outlay and $2,000 a month. So the question here is, how liquid do I want to be? In business, in life, you want to be very liquid, but you want to be creating these revenue streams. It's better to generate $1,000 in rental income than it is to make $1,700 and have this fixed expense of $2,000 and spending $12,500 in cash I have to take out of my pocket, my bank account, and spend, let alone spending $100,000 with that same $2,000 a month cash outlay. Does that make sense? So obviously when we take a look at this whole thing, you can see where I tend to lean. Now the management strategy is perhaps my favorite out of all three when it comes to cash flow. It has the least amount of risk, and even though the cash flow isn't as high, you basically carry no risk that can't be mitigated by having good liability insurance. And you never have to worry about making a payment, regardless if you can find a tenant or not. This model is super scalable and allows you to acquire a lot of properties with practically no money. It does, however, take a little bit of sweat equity and a good sense of time and self-management. And that's what I really wish I had known when I first started this journey down real estate investing, and what I would recommend to a lot of you out there who are looking to get experience and get into real estate who don't also have a lot of cash to work with. Now, at the same time, I'd strongly suggest that you have some experience dealing with rentals. Hopefully you're house hacking at this moment, because there are some nuances when it comes to managing rentals, managing a property, doing maintenance stuff that you should understand or have a good comprehension of before you start managing somebody else's property. But all in all, I love how fast you grow in this. You don't have to continually put that 20% down. The only downside is you don't get that appreciation in the long run, but that's not the important thing right now. What we're trying to do right now is we're trying to build that savings bucket and that cash flow, or those income streams. If you saw my bucket video over here, we're building those faucets out for you. And don't worry about purchasing properties right now. That's for further down the line when we can find the right opportunity. We have the cash saved up, we've got the faucets going, or the income streams, and then we can find good deals and buy our own properties at the rate and the price that we want. But to be honest, if you play this right, if you manage a well-performing portfolio, your management company will probably outpace the appreciation or the cash flow from any one or even two properties that you could purchase. Did you learn something new today? Congratulations! Don't forget to subscribe right here and like that video if you're into learning how to make money and also how to manage it. Don't forget to join the Discord server and my Instagram. If you want to chat and hang out with me some more, links down in the description below. 100% free, and I really actually just enjoy chatting with you, the viewers out there who are watching this. Thanks so much for tuning in today. I love you all, and I'll see you all in the next one. Peace out.